Is it all about yield or is it about cash flow? Stay tuned. Welcome to this week's edition of NoteSchool TV. Well, where every week at 11:05 Central Time on Wednesdays, we bring you the most amazing guest as well as the most amazing content. And again, as I say every week, and this week is no different. This is what you've come to expect, right? So with that, let's do some housekeeping. Make sure and hit that like button. Boom. Yeah, go ahead and hit that. Make sure and share this with your friends, your colleagues. And also make sure and share your story, share what's going on in your marketplace out there. So if you'll do that as well, make sure and subscribe to the NoteSchool TV channel if you have not already done so. And last but not least, make sure and hit that bell notification, boom, so that you will know when we are going live when. Every Wednesday at 11:05 Central Time. Keep those comments coming to us again. And if you'd like to know more about what we do at NoteSchool, simply go to noteschool.com/TV. Again, noteschool.com/TV. And with that, well, I want to go ahead and let's talk about what's going on in the news this week. Well, we have an article today about, well, it's from Bloomberg. Distressed property buyers seek out exceptional bargains. So distressed investors, right, see one of the best opportunities in a generation in troubled U.S. real estate assets. Wow, a generation. That is a long time, folks. We have been calling this, Eddie has been calling this really since March of 2020, when we started, when the pandemic started, saying we are going to see this wave of non-performing assets. And I thought this was pretty striking, right? Compared with the savings and loan crisis of 2008, it says we're still in the first or second inning. So we're not right there yet. That's what we've been saying as well. And according to Oak Tree Capital and Rebel Coal, there's a tsunami coming and the waters are pulling away from the beach. So yeah, guys, the big private equity firms are raising capital right now. They've one of the firms has raised several of the firms have together raised over $400 billion, right, nearly $500 billion to go out and take advantage of that. And it says that financial crisis level, if CRE values fell by only 20% from their peak, would be a tsunami. So more to come on that. We will keep you up to speed. Pardon the pun, right? Up to speed. We will keep you up to what's going on out there. So what I want to do right now, and by the way, our guests today, yes, we have a husband and wife team, are amazing. But first, I want to introduce, NoteSchool's founder, chief visionary officer, the guy that's always looking for the next over the horizon there, my friend, all-around good guy, Mr. Eddie Speed.
Well, thank you, Joe. I am very excited about the episode this week because this is a story that I've gotten to live and be part of, and getting to know this couple and getting to know really just their way of operating, their good sense about the business. I would say that they certainly done, as a teacher goes, you want to teach people to do things, but then you need to see people really implementing what you teach. And so they've done just a magnificent job of this. You guys welcome Emily Courtright and Adam Roberts.
Yay. Hi, Eddie.
Hey,
Thank
Eddie.
you so much for having us on today.
How are you?
Wonderful.
Fabulous.
Awesome. Well, Emily and Adam live here in the Dallas-Fort Worth Metroplex. Now, Emily and Adam, I think you guys could live anywhere in the world and we would have probably accomplished about the same thing. But we occasionally get to see you live because you live here, and it's great to get to see you virtually today here on the screen, right?
Yeah, we always enjoy it, Eddie.
I respect you guys a lot. I respect your taking action. I respect your judgment. You're good deal makers. You're reasonable deal makers, and that's what we're going to talk about today. We're going to talk about like what's reasonable. Like when people say buying notes and you're going to get a return on your money, what does that mean? Like, can I get 5% return or 50% return? Right? And we kind of picked you guys for this because we think you guys just instinctively have good judgment about this. You have a sense of fairness, although you certainly don't give the farm away. I don't want to say you drive a hard bargain in a negative tone, but you drive a fair bargain that's fair for all parties. Let's talk about that. When did you join Note School, first of all?
So we joined Note School at the beginning of 2023. So about a year and a half ago. And I was introduced to Note School through another mastermind that I was in. My mentor in that mastermind is a member of Note School. And so when I learned about his notes business, and I said to myself, if he learned from Note School, then I want to learn from Note School. And after the first session, I knew it was where we needed to be.
That's awesome. I remember that. That was an icy day in Austin, Texas, which they don't have many of those.
Right.
Yeah. And then Adam, you came along.
Yeah.
But I guess by the time we had a 3-day event, then you came along and did that. Both of you are engineers, right?
Yes, we
That's
are
correct.
by trade.
Yeah. So you're analytical.
To the nth degree.
You like the numbers. Yeah. You like the numbers, right?
Mm-hmm.
So I want to talk a little bit about like where you were at, because you certainly were not beginner real estate investors, right? But you were sort of at a crossroads, and I want to kind of talk about what that juncture was and how that looked.
Yeah, Eddie, about 12 years ago or so, we started buying real estate investments in the single family world, and did that for a number of years, eventually getting into larger multifamily apartment complex acquisitions, group purchases, syndications, as they're called. And we've been doing apartment syndications for the past 6 or 7 years. And it's been really good for us. But I think we've now been throughout our experience, have been able to experience almost a full real estate cycle. And when you get to live through that, you have all sorts of experiences, both financially, operationally, and we're living it today, really. Yeah. On the real estate side, what you very quickly realize is, as the owner of the real estate, you are subject to the market and everything the market can throw at you. And I'm not just talking about home prices, right? I'm talking interest rates, insurance premiums, residents keeping or losing their jobs, the ability to hire good people. It's just one huge conglomerate equation that, as we've talked about before, when we were introduced to Notes, really gave us a great mindset shift away from being the owner of the real estate into being the lender on the real estate.
Mm-hmm. So you had done rentals, you'd flipped some houses, but you have a fairly substantial amount of multifamily units under management. Mm-hmm. And obviously when people invest with you in multifamily, they're always talking about their return, right? Their yield, right? And so you had a lot of conversations with people, even people investing with you, about returns and yields and stuff. And I wanted to talk about today, because this is a big topic that everybody has all these varying opinions. And that is, what kind of a yield were you looking for? And then how did you draw some conclusions to get to that?
Yeah, for us, when it comes to real estate investments, all you have to really do is put together a simple spreadsheet, and if you can look forward far enough, let's call it maybe 10 years, 20, if you're ambitious, And it honestly, as long as you're continually reinvesting portions of your principal, it doesn't take a huge amount of yield to build massive amounts of wealth. And so for Emily and I think what we really respected from the get-go, especially with NoteSchool and the note investment vehicle, it's more about the body of work on the investment. Sure, yield, of course, that's a parameter that you need to check the box and calculate. It's an important part of it. But there's so many other aspects that can really influence, let's call it your long-term wealth plan.
Yeah.
A few of those being, hey, what's the velocity of the cash flow coming back to me? The yield might not be as high as, the yield on this investment might not be as high as this investment, but maybe I'm getting my principal back faster in this investment. And that actually can make a huge difference. Exactly. Right. The location, where's the investment located? I mean, anybody can sign up for a 15% yield, but if it doesn't pay you, it's not 15%. So we really early on respected the mindset that, hey, it's the full body of work of the investment itself. And that is multiple parameters.
I've seen a lot of people that start out with yield, and they'll start into a conversation with me and they say, well, they'll say, I want a 15% yield, or I want an 18% yield. And I'm like, you're looking for riskier notes than we buy. They don't quite know what to say to that. Right.
Mm-hmm.
And so the one thing that I kind of said in the introduction, and I want to make this point again, you guys drive a fair bargain, meaning that you don't give anything away, but at the same time, you have a sense of like what the market will tolerate and still keep the quality what you be. Like, I like how you said that, like a full body of work. Like calculating a yield on money you're not going to get is zero, isn't it, Adam?
It is.
And so because this is a common thing that people ask about all the time. Let's talk about the first couple of months in NoteSchool, right? And I'll have an example. We did a little poop sheet here that we'll put up here for the audience here in a little bit. But I want to get a sense of like when you started in this, like you got pretty aggressive pretty quick in buying notes. Talk about that.
We did. We had sold a real estate asset prior to that, and we had a chunk of money that still needed invested. And as the market was shifting and it was very obvious that the real estate investments were not going to be cash flowing like we wanted them to, we looked at each other, and after we learned about notes, we said, this money's got to go into notes.
Yeah.
So utilizing NoteSchool's resources, education, within 2 months of joining, we were confident and ready to purchase. So we utilized the trade desk, and we picked our favorite 5 notes. We were given a little tape of 11 notes, picked our favorite 5, and pushed the go button. And we said, you know what better way to learn this business than to do it? And we were prepared, we were educated, and we had the resources and systems, thanks to NoteSchool, to make that purchase.
All right. So I'm gonna go back and let's go back down memory lane a little bit, right to what you're describing, Emily. Like, what drove your investment decisions?
Some of the notes had a little bit lower yields, but great discounts. And I'll give an example. One note in particular was around an 8 yield. But what was very unique about it is that it was an adjustable rate, more adjustable interest rate. And so we knew that the interest rate was going to adjust in the very short term because it adjusted every year. And because interest rates were starting to go up, we knew that yield was actually going to increase within a month after we bought it. And so it also came with one of the biggest discounts that we have, like a $40,000 discount. And so that's a great example of one of our best performing notes in our portfolio. It has a great discount. It's in a gorgeous location. It's a $800,000 house in Fort Lauderdale, Florida. But if you would have looked at the yield initially, somebody probably passed on that.
Well, and you said a key thing there, and that is discount, because these loans tend to pay off early. And so if a loan pays off, you don't give up any of the discount, do you?
Nope. And even in 1 year, we've bought 25 notes and 3 of them have paid off already.
Yeah. Yeah. The average life of a note paying off is about 7 or 8 years. But as you said, on 25 notes, you've had a little over 10% pay off early, right? So does that surprise me? No. No, and I think it'll be the same next year. Let's pull this up. I want to pull this up for the audience and make sure everybody can see it. And let's just show them kind of a quick little snapshot of a portfolio, just so people can get a sense of what it looks like. So you guys see that? Okay.
Yeah.
All right. So this was, Emily, this was a while back. This was before you had 25 notes. This was 14 notes. And you invested about $575,000, right?
Mm-hmm.
Now, is that true that $575,000 threw off $7,500 a month?
That is a combination of the notes that we bought for ourselves for cash flow and the notes that we bought and then sold partials on. And we still have a little bit of money left in those deals.
So some of the notes you sold the front end and you're not getting the cash flow, right?
Yep.
So that's a pretty good analysis, because that means that you sold the monthly income, but you kept the wealth.
Yes.
Right. In other words, in my little analogy here, right? Here's your cash flow. You sold the first half of the cash flow. You sold that to somebody else, and then you own some residual payments in that note, right? All right. So let's look over here on the right, guys. Let's talk about these notes, and it gives you there's two columns. One says the yield and the other one says the cash flow. Let's talk about that.
Yeah. So essentially the yield is that calculation we talked about earlier where, hey, what's my return on the declining principal balance, my profit, right? And a lot of people focus on that. I honestly, I tend to focus on cash flow. I think it's kind of where we came from. We were in a crunched cash flow position. So we were initially looking for notes that gave me the most money coming to my bank account every month that I could invest in. And that's where that cash flow percentage comes in. It includes not only the interest profit, but also the principal payback, which I like to call velocity of principal coming back to my bank account.
So in the cash flow column, a simple way of describing it would be, I invested $100,000 and I got $14,200 back the first year.
There you go.
Yep.
So cash on cash return, whatever people call it. And you're right. You came from the multifamily world, and that cash flow in that industry has really gotten compressed.
A lot.
Yeah. So, so this gives, and so we talk about this a lot inside of Note School. And so I know you guys you could teach the course on this, I know, right? But people kind of get drunk on yield a little bit. Do you think that's true?
I see it. Yes.
Because people say, well, I like your note that has 12% yield, Adam. I like that note better than the one that has 10.7. And that may not necessarily be all true, right?
It's not. And actually, if I can just expand on that a little bit, the Oklahoma City note there with the nice yield versus the Abilene, Texas note with the lower yield. The Abilene, Texas note actually has, I think it's a $50,000 discount. And granted, maybe I won't see that for a number of years. But Eddie, what I tend to do when I'm looking at all the parameters, again, the body of work, I'll take that discount. I will include that in my return on investment on, like, let's call it a 7-year time horizon, as you mentioned earlier.
Yeah.
And when I'm making an investment decision, I will call that my return. And hey, if it doesn't, because it may not happen, it may be 8 or 9 years. But when you include a $50,000 return on a 7-year time frame for a $100,000 investment, that's a huge return.
Yeah, my general philosophy is, if you can buy a note with some discount in it, you always are willing to lower your yield, because you know it's probably going to pay off early, and you're going to earn that discount sooner than the note says you're going to earn it. Right? It's not going to take you 20 years to earn it, because it goes for 7 years, pays off, and boom, they pay off the whole principal amount. And then you'll learn an accounting term that your CPA will say to you, and it's just going to sound like money. He's going to say unearned discount. And that's definitely a thing. So I really like what you're doing. I like really as you're doing this, there's a couple of things at the bottom I think really make sense. And that is, you're talking about reinvesting. Now you have enough cash flow that you needed to fulfill some income that you were making on the multifamily side. And because of, that increased expenses and some decreased income, you had some personal income you need to replace. And now that you've done that, then you're now in a growth mode, right? You're now like building net worth for the additional notes you're buying. Talk about that.
Absolutely. We have continued to work with our investors to both build their wealth and build our wealth at the same time. And we have started to tailor it to some of our VIP clients and saying, what are you looking for? And we'll go find a note that meets that need. But in general, we prefer to recapitalize 90% or more of our initial investment. Like we mentioned, a discount is really powerful because then we get to keep the discount, and there's definitely a return if it pays off early. But we are, our best partial, our future cash flows are over $120,000, and we only have about $1,000 in the deal. So it is such a powerful strategy to be able to build on, and you're recycling the same funds.
Yes.
So I don't have to go and continue to make money and infuse money. I can take $100,000, buy $100,000 note, sell the $100,000 partial, and then I could do it again. And so we're doing it through my self-directed IRA, and we're doing it through cash funds. And so we have two funnels going for partial investments.
Let's talk about another thing that you guys have a lot of experience on, and that is, another way that the yield, the return that matters is how much work do you have to do on an ongoing basis? Because that has it. Like, people look at a real estate deal and I'm going to get an 8 cap at them, and all of a sudden they have to go work in the deal every day, right?
Mm-hmm.
Talk about that.
It's the one thing, and no one not nobody, enough of us don't pay attention to this. The return on your effort. It's like you said, Eddie, if you've got a 15% yield and you've struck gold, well, the minute that note stops paying, you might as well have bought the 5% yield note that was risk-free, right?
Yeah.
So it's amazing when you put a spreadsheet together to find out how much work and how little has to get paid back for the yield to just go straight down. That's why when we look at our investment criteria, it's really, the yield definitely does have to meet a certain criteria. However, it's much more important to us that it's in, let's call it foreclosure friendly jurisdictions. Payment history has a lot to do with the borrower. And we're just looking at a lot of other things to validate the yield rather than, hey, let's shop the yield and validate the other parameters.
I think it's really important too that you're actually getting the yield. Talk about that.
Yeah, you've got to measure what you've invested in, right? And what measures, what you measure gets improved and acted upon. Once you establish a pretty sizable note portfolio, it doesn't take long for one note or two notes to stumble or maybe have some late payments. And to your point, you can have a 10 yield go to 3 very, very quickly. You only have to miss like 2 or 3 payments a year for that to happen. And to your point earlier, the amount of effort that goes into let's say a non-performing note. If you get into this business seeking cash flow and performing notes, the amount of effort that goes into a performing note once it goes non-performing, it's real work, right? But it's not as much work as goes into being the owner of the real estate, the landlord, which is a huge point.
We see people investing in rental houses. We see people investing in multifamily, right? We see people investing in traditional stocks, right? Everybody, the magic word that we hear, the dinner that we always have, that you guys have with couples when something comes out about your future and you're investing, or, you know, like when you're talking to your family and something comes up about investing, yield always becomes the topic. But the truth of the matter is, these other investments, you generally don't actually earn the yield that you don't get paid for the yield that everybody talks about until it's successful at the end. And the great thing about this is you get the yield every month.
Mm-hmm. Absolutely. We've invested in some multifamily deals as passive investors or limited partners, and there was supposed to be 6, 8, 10% cash flow every year. Well, now that the market has shifted, there's zero, to your point. And, you know, if we see a return, it'll be at the end. It could be 3, 5 years from now. And so notes are much more consistent income and cash flow and yield overall. It is, like Adam has said, a velocity of money coming back in. And one thing that we do provide our investors are I don't want to say case study, but showing them that if they can build up that principal and interest that we're giving back to them within usually about 3 or so years, they can go and buy another partial. And then they can buy another one. And we show them the power of doing that, say over 10 years, and they can get just as good of returns as they can on a growth asset like large multifamily with much higher risks. As they can get those kind of returns if they just reinvest the principal and interest.
All right, so I want to dig in a little bit into that, because this is really good. I want to make sure the audience gets this. You have a certain amount of money you've put into the business, but like all of us, you run out of money at some point, right? Let's talk about this whole idea of recapitalizing. Like kind of break that down for us.
So for us as the active investors, we recapitalize by buying the note and then selling the partial at 90 to 100% of our purchase price. So we have essentially run out of our own money in terms of being able to buy new notes and leave them there to get the cash flow. And so we will borrow from my whole life policy. We will borrow from other places in our portfolio to buy the note, and then we'll sell the partial, which will recapitalize. Let's just say we buy $100,000 note, we sell $100,000 partial, get our money back, and then we're able to do that again.
You buy the whole pizza.
Mm-hmm.
You sell half the pizza, right? Then all of a sudden you have residual income because you didn't sell all the pizza, so to speak, figuratively speaking. But now you get your seed money back and you go put the hook in the water again and go catch another fish, right?
Yes.
You think there's a lot to the idea of yield is determined by risk?
I think that would be the stereotype.
That's a stereotype. For me, I've kind of learned, you know, this whole mortgage note investing, or let's just call it the real estate investing experience for me, I can very easily now split my investments into, you know, growth investments and principal cash flowing investments.
Yeah.
Going back to your point, Eddie, about, you know, multifamily and people making investments in the multifamily world. It's very true. Even in a good market, where, say, I can give somebody 15 to 20% yield in a multifamily real estate investment, of which they will see most all of that at the end. Mm-hmm. That same investor can get pretty much the same yield over a 5-year time frame. I mean, if they're only interested in yield, they can get pretty much the same yield over a 5-year time frame in a cash flowing principal velocity investment like a mortgage note. And they've got full control of their money the entire time. I can't tell you how important that is, especially for folks today who wish maybe they didn't make a growth real estate investment in this current cycle we're in.
Yeah, there's a cool thing about notes is you own the note, right? And when you're invested in a syndication, you own a share that you really don't have a lot of control over. And I know you guys are good operators, but not everybody in that business are great operators, right? And you're kind of betting on their performance and some other things like that. You know, I like the idea. I like this topic of yield because it really gets us to, you know, the fact that most everybody, let's just call it with a driver's license, right? Most every adult, right, always puts so much emphasis on yield. But what you guys have pointed out to us today is yield can be calculated more than one way. Yield, when you hadn't gotten the money yet, may be money you never get, right? We can own a stock that goes up in value and we can go around the country club telling everybody what our yield is, but unless we stole the stock, we never got paid for it yet, right? And I think you guys have done a really good job of like drawing a conclusion between anticipated return and recognized return, right? That's a big difference in the two. All right. Bonus question. If you had it to do over again, what would you do differently?
You know, I think after buying 25 notes, the only thing that I would be a little bit more keen on is during the transfer process, just really keeping track of the escrows and the escrows that are being charged to the borrower. For example, we just had one come up and we bought it 6 months ago, bought the note 6 months ago, but they never adjusted the taxes. So we're short on taxes. That's normal. It's a normal part of the process. But as engineers, we say, well, how could this have been fixed? And it could have been fixed by when the note transferred to the new servicer, the servicer looked and said, oh, we're not going to have enough for taxes, and adjusted it back then 6 months ago instead of today when the taxes are due. So it's just process things like that we see as having the right checklist for us, making sure that we cross our T's and dot our I's, and also hold the loan servicers accountable too, and say, okay, well, what happened in your process that you didn't adjust the escrows 6 months ago? And so as we go through our learning experiences, we are trying to engage with the professional providers that we use and say, how can we make this better going forward?
I speak a lot about servicer management, right?
Mm-hmm.
That's experience, right? No, you're totally correct. And you know, like this is none of this is going to result in a loss. It's going to result a little bit in some aggravation. But you know, next time you're right, you'll tighten up some processes up front that, you know, we'll try to look at that. Adam, anything to add to that?
Well, for me, I just, you know, diversification, Eddie, has become a big, you know, it's a big vocab word in our household the past couple of years. I just, looking in the rearview mirror, I think we should have, would have, could have started doing that earlier. You know, day one, had a little bit more. I mean, when you get into real estate investing, when you look at your buddies that do stock market investing, they're all diversifying. And for some reason, you get it over in the real estate world, you're like, oh, I'm just going to go do this one thing. But and listen, having a focus is great, but at the end of the day, being able to have growth assets and cash flowing, let's call it velocity of your money assets, man, it just makes a huge difference.
And one thing about diversity too, Adam, is that when you're buying these notes, you're buying different notes. So not all your money is tied up in one deal. We're in, you know, these big apartment complexes. A lot of your money is tied up in one deal. That one thing has to go good. And so, you know, there is a risk assessment in that. The smartest money managers in the world all focus on diversity. And I think there's a lot of different ways to look at that. Thank you guys. Thank you for sharing. You've brought a very analytical and take action approach to this business, which I alluded to, and we're honored to have you guys as part of what we do at NoteSchool. But you've helped us a lot today. You've helped us see how the decisions you made and why you made them. And I'm congratulating you, and I'm gonna say keep going with it.
Thank you, Eddie.
Thank you.
We really appreciate you and the team's support.
All right, Joe, let you close us out, buddy.
Adam, Emily, you guys are amazing as always. These two guys have, well, they exemplify what our membership looks like at Note School. We appreciate you guys. We appreciate what you do for other students out there as well. So thank you for being our guest this week. And well, next week, guys, will be our well, it's going to be our monthly update. So we look forward to doing that, and have a great week. We'll see you next time.